In this video, I'm going to be covering stocks and bonds. Stocks represent a unit of ownership in a particular company. An IPO, or an initial public offering, is when a company first offers their stock for sale to the public. Shareholders or stockholders are individuals who purchase shares of stock. The stock market is a place where stocks are traded or bought and sold, and this can happen in person or it can happen virtually. And two big stock exchanges are the New York Stock Exchange and NASDAQ. A stock index refers to the average price of a group of stocks, and indexes are used as benchmarks. So the Dow 30 represents 30 large publicly owned companies, and these indexes are reported on by the financial news every single day. The S&P 500 is a much broader index because it includes 500 companies. A common stock is the most basic form of ownership in a corporation, and the ownership is determined by how many shares you own. Common stockholders usually receive voting rights. In contrast, preferred stock is more of a fixed income stock because it pays dividends, and I'll explain what dividends are in a minute. Preferred stock, usually you do not receive voting rights. A growth stock refers to companies that are reinvesting their earnings back into the companies and not paying dividends. So these companies very often are in the startup phase or the growth phase of the business cycle. Income stocks would be attractive to the more conservative investor because income stocks are less volatile as they pay regular dividends. A blue chip stock is a description that's given to stocks of well-established companies that have a track record of proven profitability and often pay high dividends. So companies such as Walmart or Apple are examples of blue chip stocks. And the stocks that are included in the Dow Jones 30 are blue chip stocks. Dividends are distributions of cash or stock as a way of a company sharing their earnings with their shareholders. Before you invest in stock, you want to make sure you do research. And there's a variety of places that you should be doing research and places to look. You can want to look at the company's revenue and their track record of profitability. You want to look at the current price as well as the history of the stock price. You want to look at market capitalization or the value of the company's outstanding shares. You want to take a look at the financial statements and also pay attention to press releases as well as news items that have been published on the company. In order to buy stocks, you can purchase them through a broker. You could purchase them directly from the corporation, or you could buy them through a low-cost online firm. In order to calculate returns, you want to take the return or the change in value of the stock plus any dividends that have been earned, minus any commissions and fees that were paid, minus taxes on the earnings, and that will give you your return on investment. The second type of asset we're going to talk about are bonds. Bonds are a debt security in which an investor loans money to a bond issuer. So investors receive a fixed rate of interest for that loan. The face value of the bond is the stated value of a bond when issued in the amount that you would receive back when the bond matures, because again, you're making a loan when you're investing in bonds. The maturity date is the date by which that bond has to be paid back. So many different types of entities will issue bonds. So corporations issue bonds, and those bonds are secured by the future profits and the assets of the company. Government bonds are issued by the federal government, and those are lower risks relative to corporate bonds. Municipal bonds are bonds that are offered by state, city, and local governments, and those bonds are usually tax exempt. A bond rating is kind of a credit score or a grade that indicates the credit quality of the bond issuer. A bond yield is referred to as the income earned is an annual percentage. Bonds pay fixed interest, and those interest payments are usually received twice a year. So the idea of ownership versus loanership. When you think of investing in stocks, think of stocks as a way of owning a part of that company. In bonds, in contrast, you're loaning money. So you become a creditor of that company or government entity.